Understanding capital gains tax is important for anyone who sells an asset and makes a profit. Capital gains tax is a tax on the profit you make when you sell something that has increased in value. This can include things like stocks, real estate, cars, or even collectibles. The first thing to know is that not all gains are taxed the same way. There are two main types of capital gains: short-term and long-term. Short-term gains happen when you sell an asset that you owned for 1 year or less. These are usually taxed at your regular income tax rate. Long-term gains happen when you sell an asset that you owned for more than 1 year. These are often taxed at a lower rate than ordinary income. To calculate your capital gain, you subtract the original cost of the asset from the selling price. This difference is your gain. However, there are some expenses that can reduce your gain, such as fees paid when buying or selling the asset. There are also exemptions and exclusions that may apply. For example, if you sell your primary home, you might be able to exclude a certain amount of the gain from taxation. The exact amount depends on how long you lived in the home and other factors. It's also important to note that not all assets are subject to capital gains tax. Some investments, like municipal bonds, may offer tax-free income. Additionally, losses from selling assets can sometimes be used to offset gains, which can help reduce your overall tax liability. Each country has its own rules about capital gains tax. In the United States, the Internal Revenue Service handles these taxes, while other countries have their own tax authorities. It's always a good idea to consult with a tax professional or use official resources to understand how capital gains tax applies to your specific situation. Keeping track of your investments and their costs is essential for accurately calculating any potential capital gains tax. Using records and tools can help you stay organized and prepared when it's time to report your taxes.